Are you tired of not understanding from where the market is likely going to expand in a quick manner? Then this lecture is for you. During this lecture I'm going to be sharing with you the concept of balanced price ranges. I'm going to be explaining to you how you're able to anticipate low resistance liquidity runs. Welcome to this new lecture. Balanced price ranges, the institutional blueprint. Price only expands away from a range once it has been balanced. This is how efficient market delivery is the key to anticipating big price swings. Look, if you do not understand the concept of balanced price ranges and you're purely coming to the charts with the perspective of, okay, here I see a price pattern and therefore I'm going to be looking to trade, what's going to happen is that you will get caught up in high resistance liquidity run environments. You need to understand that price will only expand away from a specific range in a quick manner once that specific range has been balanced out. Therefore, balanced price ranges are a crucial element within your analysis. All PD arrays are balanced price ranges, meaning all of the PD arrays, which you can see right here, are balanced price ranges in their core nature. For example, a rejection block is a lower time frame balanced price range. An order block is a lower time frame balanced price range. A fair value gap, once it has been rebalanced, becomes a balanced price range. A bearish breaker or bearish mitigation block, all balanced price ranges. So what you can see is that every single PD array which you've ever used within your own trading all boils down to it working because of it being a balanced price range. Therefore, you need to understand that the PD array itself doesn't really matter, but what truly matters is the logic behind the PD array, and that is what I will be explaining to you during this lecture. And I promise that by the end of this lecture, you will never be able to look at the markets from a price perspective from the same perspective ever again. Let us dive into the theory behind balanced price ranges. A balanced price range is a range which has seen an equal amount of sell side as buy side delivery. And I know that right there might sound a bit complicated, and therefore I have created a schematic of a seesaw. The reason why I like to use this analogy is due to the following. A seesaw is basically the thing that people take their kids to within the garden or within like the playground, and two children sit on each side. And the one that is heavier goes to the ground, whilst the one that is lighter goes into the air, right? You know what I mean. When it comes to balanced price ranges and you understand that there has to be an equal amount of both sell side as buy side delivery within any given range, you begin to understand, hey, before price is allowed to expand away from a specific range, there has to be balance, meaning there has to be 2 times sell side delivery, as you can see right here on the left, and 2 times buy side delivery, as you can see right here on the right. Once it is the case, the seesaw is in balance, and that right there shows to you that price is now allowed to expand away from that given range. An imbalanced price range is then a range which has not seen an equal amount of sell side and buy side delivery. Once you see this and you recognize that the price range is imbalanced, you can already anticipate that at one point in the future, price will have to come back to that given range to offer buy side so that the range can become balanced. And this right here is the core principle behind balanced price ranges, and this is the reason why the market expands away from any given range once it has been balanced out. So when it comes to MMXM market maker models through the lens of balanced price ranges, what I would like you to understand is the following. On the left you can see the market maker sell model, and on the right you can see the market maker buy model. And if you do not understand market maker models yet, I highly suggest you to study my lectures on my public YouTube channel, which you can find below. If you study these lectures, I'm sure that you'll be able to understand MMXM, and then when you come back to this lecture, you'll be able to understand how balanced price ranges play a crucial role within the MMXM. When it comes to balanced price ranges within any market maker model, what's important to note is first of all that the market maker model consists of both buy side as sell side delivery. The buy side of the curve to the left right here, and the sell side of the curve on the right here. If you look at the market maker buy model, you of course have the sell side of the curve on the left side of the curve and the buy side of the curve on the right side of the curve. This right here is already an equal amount of sell side and buy side delivery from a bigger perspective. However, when we zoom into the MMXM and we pay attention first of all to this smart money reversal right here, what you can see is that the reason why the market reverses there is because this reversal, its range, is being balanced out from our point of interest. The moment that the market then displaces lower and we see our low risk sell taking place, that right here is also a balanced price range. The moment that the next entry opportunity presents itself after price expands lower once again, that becomes again a balanced price range. The same applies to the market maker buy model, where the moment that price reaches a point of interest and we see that smart money reversal taking place, that right there becomes a balanced price range. The moment that the market displaces higher and we see our low risk buy taking place, that again becomes a balanced price range. The moment that price expands higher once again, that again becomes a balanced price range once that next entry opportunity presents itself. And the main takeaway which I want you to take away from this schematic right here is that the left side of the curve determines how the right side of the curve is going to deliver. Meaning, by paying attention to how we saw delivery taking place on the left side of the curve, you can already anticipate when and where on the right side of the curve your entry opportunity is going to be presented. And that right there is so important to understand. When we pay attention to a chart example then of what a balanced price range looks like, we are going to be looking at the following schematic. And we are going to be paying attention to one specific fractal at first, but I'm going to be sharing with you more fractals later during this lecture. The first fractal which I'm going to be sharing with you is what I refer to as the juicy market structure shift pattern. This pattern is the most powerful algorithmic signature out there. There's no algorithmic signature which is more powerful than this schematic in front of you, where you can see that we have a CB, a bearish value gap, right here on the left side of the curve. We have a high which forms inside of that bearish value gap, and we see the market displace through that high. Inside of that displacement leg, what we can see is that there's a bullish fair value gap. So just to summarize, we have a CB, high, BC. The moment that the market retraces into that BC, we're anticipating a swing low to form in this area so that the market can then expand towards the upside, towards the draw on liquidity. And the reason why is due to the following. I'm going to be sharing with you some counting tips. And this is how you can look at balanced price ranges and determine whether or not the price range has been balanced. What you can see right here is that we have a CB. So what is present right there? Well, a CB basically means that there's only sell side delivery which is taking place inside of this range. Therefore, in the future, buy side delivery has to take place. So what you can see is that buy side gets delivered into that CB right here, and the market expands lower, reaching the weekly and monthly open. This right here was the shorting opportunity which I provided on Wednesday. When we then saw the market expand higher after reversing from here, what we saw taking place was that the market took out buy side liquidity resting above this high, and then we saw the market retrace. Now, when it comes to balanced price ranges, what's important to note is that we always take the highest high inside of the CB, meaning my eye is drawn first of all to this high, and we take that out and we form this high. So moving forward, heading into the next day, what it will be monitoring is the reaction to this high right here. If we see the market displace away from this CB and trading above this high, my eye is drawn to the imbalance which will be created during that leg. So what you can see right here is that we have CB, sell side delivery, buy side delivery, and we then see the market over buy side through that CB again. During that buy side delivery, what's occurring? During that buy side delivery, there's a lack of sell side delivery inside of this impulse leg towards the upside. Therefore, what must happen? Because we see a bullish fair value gap, a BC get created, a retracement has to occur inside of that bullish fair value gap so that sell side can be offered, and as that sell side is being offered, that right there is where high frequency trading algorithms are going to be firing in their long positions. So what you can see is that the market retraces into that bullish fair value gap, and there were multiple buying opportunities which occurred inside of this area before the market eventually expanded towards the upside. This was a beautiful trading day where I netted over $100,000 in profit, which I posted on my public Telegram channel. You can find the link to that below in the description. So market structure shift pattern is present right here on the hourly chart. This right here is the strongest algorithmic signature which you can see. But what if I told you that's fractal and occurs across all different time frames? And the reason why is because this is how price is being delivered. It all comes down to balanced price ranges. That right there is why the market is expanding away from any given price level. So to not utilize them is, it's simply not good. So when we pay attention to another example, what we can see is that the market expanded towards the downside right here, and we saw this CB getting created. A retracement higher into that CB occurs, and we then saw the market reprice lower once again, taking out sell-side liquidity resting below this low. The moment that the market displaces above the high, which formed inside of the CB, we pay attention to the bullish fair value gap, which forms inside of that displacement leg. What we see taking place is that the market consolidates and slowly grinds higher, expansion higher occurs, and then the market quickly reprices lower. Do you see how it reprices exactly into this candle's high before the market continues expanding higher? What's happening there is that this price range is being balanced out, and therefore the moment that that price range becomes balanced out, that is when IPTA can continue the real delivery, which is towards the upside. What you can see is sell side delivery, buy side delivery, sell side delivery away from this CB, and we then see buy side delivery through this CB. What is imbalanced right now? The imbalance is on the sell side, and the reason being is because there's a lack of sell side delivery which took place inside of this displacement leg higher. That is why that bullish value gap gets established. Price will have to retrace into this bullish value gap to offer sell side so that the next delivery can then occur towards the upside. Beautiful expansion leg towards the upside, followed afterwards. Must be random, right? Man, oh man, once you start to begin to see these things again and again, you're going to be like, damn, yep, it has been hidden in plain sight all this time. And I'm literally sharing for free right now what you can be looking for when it comes to price. And once you start to see this, yeah, it's going to be like, damn. When we pay attention to another chart example then, what I would like to see is I would like you to see that this is the 1 minute time frame of Nasdaq. And I would like you to pause this lecture for a moment and be sure to pause it. I know that many of you just skip through these parts and you just want to get through the answers right away. But I would want you to think about that, what you see in front of you. And I would want you to try and figure out where you see the balanced price range. Pay attention to the market structure shift example. I'm going to be introducing a second fractal to you as well. I hope that you paused the lecture because I'm now going to be sharing my lipstick with you. Here I've annotated the chart, and what you can see is that I've annotated two specific ranges. First of all, what you can see is that I've annotated this CB right here. Notice that inside of this CB we saw this high form. Notice that when we pay attention to the right hand, we see the market displace through that high with a BC. Do you see how the market retraces into that specific high multiple times before the market eventually expands higher in a low security run? Every single time that the market is stepping into this high, what's happening there is that the longs are being refilled. So what that means is that inside of this consolidation, high frequency trading algorithms are doing one thing. They're buying, they're buying, they're buying, they're buying, they're buying. Why? Because the underlying order flow changed from sell program to buy program, and therefore you can anticipate that this CB will function as a true inversion to value gap. Do you see that an inversion to value gap is not simply a CB being displaced above and boom, there we go? No, there's so much more going on behind the scenes, and that is why you cannot pattern trade these price patterns, because you need to understand what's going on behind the scenes to understand when and where those specific patterns are likely going to work, but more importantly, when they're likely not going to work. So this right here is the market structure shift pattern, CB, high, BC. Next to that, what you can see is that I've outlined this range right here, and the reason why this range is important is due to the following. What I would like you to see is that the market expanded lower after we saw that high formation taking place inside of this higher CB. As this expansion lower occurred, we saw the market trade below the 1 p.m. open, the cycle opened for the current 90-minute cycle, trade below the midnight open, and we then saw the market displace higher. Notice, however, that when we pay attention to this expansion lower, it wasn't just one dump. It wasn't just one repricing lower. No, we saw an expansion lower, retracement higher, expansion lower. So when it comes to market maker models, you need to understand that this fractal right here from this high to this low is already the sell side of the curve within this market maker buy model. So what you see is sell side of the curve, buy side of the curve. If we pay attention then back to the schematic which I outlined, where MMXMs can be looked at through the lens of balanced price ranges, whenever you see a retracement taking place on the left side of the curve, The moment that price displaces above that retracement, what you can anticipate is that that retracement range from low to high is going to function as support and price. So as the market trades above this specific candle's high, you want to see this range function as support and price. And what do you see? You see the market consolidate inside of this area right here. And what's happening right there is the same principle which I explained to you right here. Longs are being filled. Why? Because from this moment in time, it's confirmed that price is now in the buy program. And from there on, you can anticipate that balanced price ranges are going to be established. And once they are established, that is when that next impulse leg is likely going to take place. When we pay attention to another chart example then, which is of the same session, I would like to pause the lecture once again, and I would like you to try and see where the balanced price range is. I hope that you paused the lecture, because I'm now going to be adding my lipstick to the chart. Here I've added my lipstick to the chart, and what you can see is that it's exactly the same fractal, where you see bullish fair value gap, retracement into that bullish fair value gap, we see the market expand higher, time distortion is taking place, this is where the market is consolidating, where price is being held inside of a very tight range, whilst time is simply printing. And eventually we see 230, the next 90-minute cycle, open, high, followed by displacement through this candle's low, which formed inside of that bullish value gap. How do we displace through it? We displace through it with the creation of a bearish value gap, a CB. So what you can see is that for the bearish sequence, we are paying attention to a BC, low, CB. Bullish value gap, low forming inside of that bullish value gap, displacement through that low with a bearish value gap. The moment that the market retraces into this low right here, that right there is when buy side is being delivered into the imbalanced price range. From that moment in time, efficient market delivery is taking place. And the moment that the market expands away from it, that is when the price range becomes balanced. Are you beginning to see how crucial this factor which I'm explaining to you is? Balanced price ranges are the key, because you could also say, oh, but this right here is a bearish breaker. It's not simply a bearish breaker. It's not simply the low which set up the final push higher. No, that's not what's taking place. What's happening right here is that the price range of this bullish value gap is being balanced out so that the market is then allowed to expand towards its next sales liquidity objective. Beautiful low resistance liquidity run followed afterwards. When we pay attention a bit further in the delivery then, what you can see is that I'm going to be sharing with you the next fractal for determining a balanced price range, and that's the following. We have a bullish value gap right here on the left side of the curve, and we see the market displace through that on the right side of the curve with this bearish value gap. Therefore, this bearish value gap has to function as resistance on price. We have a bullish value gap, bearish value gap. What we have is we have a lack of sell side delivery right here inside of that bullish value gap creation, and we have a lack of buy side delivery through that bullish value gap as the market is creating this bearish value gap. Therefore, we must see buy side delivery, a retracement higher taking place, IOFET, institutional order flow into drills taking place, and the reason why IOFET occurs is due to balanced price ranges. That's the sole reason why IOFET takes place. And as that occurs, we see the market expand lower beautifully, drawing towards its objective. When we pay attention to another chart example then, what you can see is that we are looking at a bearish example once again, where you can see that the market expanded towards the upside, and we see the market form this bullish value gap right here. We saw the market expand higher once again, and there was one more bullish value gap creation. Here I'm going to be introducing to you the concept of immediate rebalance, which is again a form of balancing out a price range. What you see occurs that the market forms this high, and it then slams towards the downside with this large down close candle. Notice that the market slams through this bullish value gap. The next candle opens high and reprices into this up-close candle, its low. As the market is repricing higher into this up-close candle, its low, what you can see is that the price range of this down close candle is being balanced out right away. Because inside of that down close candle, there was only sell side delivery which occurred. So inside of this wick, buy side delivery is taking place into this up-close candle, its low, and when the market then expands lower from there, what you can see is that sell side delivery is taking place. Market reprices into this bullish value gap. We see a low form in that bullish value gap, and the market retraces higher. Notice that we reject the bullish value gap right here, and we then see the market displace lower. Do you see how a market stock shift pattern is being set up right here? BC, low inside of that BC, CB through that low. We see the market retrace into that low throughout the next cycle, and what we see occur is that the market then expands beautifully towards the downside. So what you can see is that these balanced price ranges are being created in many different forms. During this lecture, I've already shared multiple forms with you that you can start paying attention to recognize when and where a price range is being balanced out, because I promise once you're able to recognize that the price range is being balanced and you already know that we're forming a swing higher, swing low, man oh man, it's a beautiful sign. And I truly hope that you'll be able to experience what I felt when I began seeing this for the first time. And it's actually a funny story because I've shared this with my private mentorship students one day as well. But when I was younger, I was studying ICT a lot. I was listening to Michael explain certain topics. And when it came to the topic of BPRs, he explained it in a very mysterious way. He didn't explain it in much detail. So it really had me intrigued because I was like, there must be a reason why he's not touching on this in depth. So I began thinking and I began just sitting in the back of class with my notebook, with a pen, and I was just writing down why, oh why is a price range balanced and what is the difference between a balanced and imbalanced price range. And then all of a sudden it clicked. I remember just thinking about, okay, if we have twice sell side delivery and once buy side delivery, that means that there's an imbalance. I would simply envision it on a seesaw, like I've shown to you during this lecture, where you have twice sell side delivery on the left, so that is heavier than once buy side delivery on the right. That right there is an imbalanced price range. And I remember as if it was yesterday, me writing that down in my notebook in the back of class. I believe it was even an economics class, and it was just for me like one of the biggest insights which I had, and that is also why I'm creating this lecture right now, because I know what kind of impact this understanding has given within my training. And I truly hope that once that light bulb moment takes place, where it's like, damn, you begin to understand the logic behind BPRs, you begin to become able to see them, from there on, your analysis will never be able to be the same. Why? Because you're able to anticipate when and where these key X points are going to occur, both on the higher time frames as on the lower time frames, because it's all fractal. But hey, there's no algo, right? It's hilarious what some of these guys online are saying. And before I go on the whole rabbit trail, that's how my mind works. So I can go very long rants. I don't want to do that, but you tell me that this is buying and selling pressure taking place across all different time frames, across all different asset classes at all times, every single day, every single week. It's the same algorithmic signatures again and again. There's absolutely no way that this can be buying or selling pressure. Absolutely not. Especially when you time it down to the minutes. But that's all I'll say about it. And trust me, just go into your charts. And I don't want you to believe anything I say. I don't want you to just take my word for everything which I'm sharing with you. You need to go into your own charts. You need to investigate. You need to be the one that sees this. All I'm doing is I'm sharing with you the revelations I had, the insights which I was able to achieve. And once you're able to see these things, from there on, you're able to make up your own mind. Don't just think, oh, this guy says there's no algorithm, therefore there's no algorithm. Think for yourself. Don't be a sheep following on other people. You need to become an independent thinker. And that is the mindset which I'm cultivating right here by saying this. Final example which we're going to take a look at. What you can see is that we again have a CB right here. See the market form a high inside of that CB. We then have this final push towards the downside, taking out sell side liquidity, resting below this low. Market displaces through this high right here, which formed inside of this CB. With a BC, so the market expands higher, engineer sell side liquidity above that bullish value gap. We eventually see the market retrace, consolidate, and then expand towards the downside. And where does the exact low form inside of this candle's high? Buying pressure, right? Yeah. With that being said, this lecture comes to an end. I hope that you found it insightful. I hope that you are able to realize the importance of BPRs, Because I'm telling you up straight, if you do not understand BPRs yet, this has to become your main priority, because BPRs are the sole reason why price expands away from any range. Please let me know in the comments if you found this lecture insightful. Be sure to subscribe and turn on notifications as well if you would like to be notified whenever I release a new lecture like this. I'm planning on releasing way more lectures because the remainder of this year for me is all about making an impact. That right there is why I'm sharing all of this for free here on my public YouTube channel. I want to wish you good luck in your studies and I look forward to speaking to you in your next lecture. Be safe.